There are moments in history when a single decision doesn't just make headlines, it changes the future. This is one of those moments, because in the last 48 hours, something happened between the United States and Canada that no one, no economist, no diplomat, no political analyst, thought was even possible. And at the center of it all is Donald Trump, a leader known for bold moves, but this time the consequences may go far beyond politics. What he just did could trigger the biggest economic confrontation between two allies in modern history, and the most shocking part is that most people still don't fully understand how serious this situation has become. For decades, the relationship between the United States and Canada has been one of the strongest alliances in the world, defined by trust, economic interdependence, and stability. These are two nations that share the longest peaceful border in history, economies deeply intertwined, and strategic partnerships that have shaped global order for generations. But that stability was shattered when Trump invoked Section 301, a powerful and controversial tool in U.S. trade law that allows the president to act unilaterally against foreign countries he believes are engaging in unfair trade practices. No Congress, no international court, no delay. Just one decision, and everything changes. And this time, the target wasn't a traditional rival like China or Russia. It was Canada. The accusations centered on digital taxes, dairy policies, and environmental regulations. But the real impact went far beyond policy disputes. This move gave the United States the authority to impose tariffs of up to 60% on Canadian goods, everything from oil and automobiles to aluminum, lumber, and energy exports. Entire industries were suddenly under threat, and the economic shockwaves began almost instantly. But what truly escalated the situation was what followed. The Trump administration didn't just stop at tariffs. It moved aggressively, freezing certain Canadian assets held in U.S. financial institutions, restricting visa processing for Canadian business professionals in key sectors, and warning American companies about engaging with Canadian firms deemed non-compliant. This wasn't just trade policy anymore. This was escalation into economic warfare. For a brief moment, the world expected a familiar response from Canada, measured, diplomatic, cautious. But that expectation was quickly shattered, because Canada now has a new leader, Carney, and within just 6 hours he made it clear that this was not going to be business as usual. Instead of issuing a quiet statement, Carney addressed the nation directly, delivering a message that carried both defiance and clarity. Canada would not be bullied, not by anyone, not even by its closest ally. And then came the response that changed everything. Carney invoked the Critical Infrastructure Protection Act, a rarely used legal mechanism that allowed Canada to designate key sectors as vital to national security. What followed was a strategic move that stunned analysts around the world. Canada identified its most powerful assets, energy exports, critical minerals, airspace, and transportation corridors, and effectively put them on the table as leverage. This was not just retaliation, it was a calculated demonstration of power. Because while the United States may have the larger economy, Canada controls resources that America depends on in ways many had underestimated. Consider energy alone. Canada supplies nearly 4 million barrels of oil per day to the United States, accounting for a significant portion of its imports. Entire regions of America, the Midwest, the Northeast, and parts of the Pacific Northwest, rely heavily on this supply for heating, transportation, and industrial operations. For years, this relationship was considered untouchable, too essential to disrupt. But Carney challenged that assumption, pointing out that Canada has spent years quietly diversifying its markets, building pipelines to the Pacific, strengthening ties with Asian buyers, and reducing its dependence on the U.S. When he announced a review of energy exports, it was not an empty threat. It was a signal that Canada now had options. Markets reacted immediately. Oil prices surged, gas futures spiked, and utility companies across the United States began issuing warnings. Governors from key states started calling Washington in alarm, realizing that this situation could quickly spiral out of control. And energy was only the beginning. The second layer of Canada's strategy involved critical minerals, resources essential for modern technology, from smartphones and electric vehicles to advanced military systems. Canada is one of the world's largest producers of lithium, cobalt, and rare earth elements, and the United States relies heavily on these imports, not just for consumer goods but for national defense. By signaling a review of these exports, Canada introduced a level of risk that sent shockwaves through the Pentagon and the broader defense establishment. Suddenly, what began as a trade dispute was evolving into a national security concern. And then there was airspace, an often overlooked but critically important factor in global logistics. Hundreds of American flights pass through Canadian airspace every day, connecting the U.S. to Europe and Asia through the most efficient routes available. Any disruption to this system would increase costs, extend travel times, and disrupt supply chains. Even the possibility of restrictions was enough to send airline stocks tumbling and industry leaders scrambling. The estimated cost? Up to $40 billion annually. Carney's strategy was precise, targeting vulnerabilities that would create immediate and visible pressure within the United States. And it worked. On Wall Street, the reaction was swift and severe. The Dow Jones dropped sharply. The S&P 500 experienced one of its worst sessions in months, and key sectors, from airlines to energy to banking, suffered heavy losses. Investors began to realize that if this conflict escalated, the consequences could extend far beyond trade, potentially destabilizing the entire North American economic system. Yet, in a surprising twist, Canadian markets began to stabilize after the initial shock. The Canadian dollar strengthened, energy stocks surged, and global investors started to view Canada as holding a stronger position in this confrontation. This shift in perception was significant. What was intended as a demonstration of American strength was now being interpreted as a strategic miscalculation. Politically, the situation became even more complicated for Trump. The states most affected by this conflict, Michigan, Wisconsin, Pennsylvania, and Minnesota, are not only economically tied to Canada, but also critical to the American political landscape. Businesses in these regions depend heavily on cross-border trade, and any disruption threatens jobs, supply chains, and economic stability. As the reality of the situation set in, political leaders, business groups, and voters began expressing concern. Rising energy costs, potential job losses, and supply disruptions turned what might have been a distant policy issue into an immediate and personal concern for millions of Americans. At the same time, Carney was moving quickly on the international stage, strengthening relationships with allies across Europe and Asia. New trade agreements, alternative supply chains, and strategic partnerships began to take shape, all pointing toward a potential shift in the global economic order. For decades, the United States has maintained its influence through its central role in global trade. But if countries begin to reduce their dependence on American markets, that influence could gradually diminish. This is the broader implication of the current crisis. It is not just about tariffs or trade disputes. It is about the future structure of the global economy. As the situation continues to unfold, the path forward remains uncertain. Both sides have taken strong positions, and neither can easily back down without political consequences. The best-case scenario involves de-escalation, a negotiated solution that stabilizes markets and restores some level of trust. However, if tensions continue to rise, the risks increase significantly. Tariffs could be implemented, countermeasures enforced, and economic disruptions intensified. In such a scenario, the impact would not be limited to governments or corporations. It would be felt by ordinary people through higher prices, reduced job opportunities, and increased economic uncertainty. Beyond economics, there are deeper concerns about the long-term relationship between the United States and Canada. For over 2 centuries, this partnership has been defined by cooperation and mutual benefit. But trust, once damaged, is difficult to rebuild. Even if the immediate crisis is resolved, the effects may linger, influencing future policy decisions and strategic planning. Canada, in particular, may continue to pursue greater economic independence, diversifying its partnerships and reducing reliance on a single market. Meanwhile, other countries will be watching closely, drawing their own conclusions about the reliability of international relationships in an increasingly complex world. This moment may ultimately be remembered not just as a trade dispute, but as a turning point, a moment when long-standing assumptions were challenged and new realities began to emerge. And as the world watches, one question remains: what happens next? Because the decisions made in the coming days and weeks will not only determine the outcome of this conflict, but may also shape the future of global power for years to come.